Hello and welcome to my channel, Everything to Know. Here we will discuss money, investing, stocks, and everything in between. I'm your host Moshe, and welcome to my channel. Please subscribe and hit the like button. It would be I would much appreciate it. Thank you. I appreciate it already. Here tonight we're going to discuss the Federal Reserve and how they're about to raise rates, or they claim they're going to raise rates very soon. So basically the Federal Reserve met the last meeting that they had. They released these something called minutes, and minutes are basically the discussion that the Federal Reserve Board, a bunch of board members or governors, as they call them, discuss what they're going to do next. The Federal Reserve has a lot of power, and they have the authority to basically determine what rates they would charge a bank to lend money overnight. So that's called the Fed rate. I know I'm butchering this a little bit, so forgive me, but I'll dive into it, I assure you. So the Federal Reserve basically determines interest rates. All rates are determined based on what the Federal Reserve decides to make. So as of right now, the Federal Reserve, the interest rate that the Federal Reserve has is close to 0%, which is obviously zero. It's low. It's nothing. So banks can only charge so much based on that Fed rate. And that determines how the money supply, or how it determines how money flows. If you raise interest rates, you are now tightening the money supply, meaning it is going to be more difficult for people to go to a bank and get money, because the consequence of raising rates to a bank is that now you have to be a little bit more credit worthy. First of all, one, if you're going to borrow money, you would like to get it at the lowest rate possible, because obviously you're going to use that money to invest it in an asset, in a business, in anything that would produce a higher rate of return. So if you get for instance, we'll use the example of real estate. In real estate, the mortgage rates are extremely low. So if I was to go buy a property and I could get a mortgage at, for example, 3.75% for 30 years, that is phenomenal. Now I take that money and I go buy a property. Now, if that property can yield, basically I could get rent for 6%. Now, if you take the 6% rent income that I'm making every year and you subtract it by 3.75%, that difference is my profit. That's my margin of profit, or my margin of safety, but it's your profit. That's your return, your rate of return. Excuse me, I know I just butchered that, but it's your rate of return. So the rate of return is determined in this case based on the interest rate a bank is willing to give me and how much money I can get in return from that investment. So back to the Federal Reserve. The Federal Reserve now has decided that they're going to raise rates sooner than they expected. So it looks like they're going to raise rates in March. Now, CNBC has an article which I'm going to share with you right now. And one moment. Here we are. So here we are. The Federal Reserve puts wheels in motion basically for balance sheet reduction. Basically what they're saying here is that, let's see, the minutes indicate the official regular. So the balance sheet of the Federal Reserve is basically this. The Federal Reserve is the last resort. Essentially, what does that mean for us as investors or consumers or in any or citizens of this great country called America? So the consequence, or excuse me, the what's important here to understand is that the Federal Reserve can basically buy treasuries. Treasuries are issued by the United States Treasury, which is basically an arm of the federal government. So they can sell bonds to basically get income, and the rates on that bond is what they would pay out until the bond is due. For example, a 10-year bond yields 1.7%. So for 10 years, so for every year, the US Treasury would have to pay the person who owns that bond 1.7% year over year until the 10th year, which is when the bond is due. And then they get back their $10,000, for instance, if they started with $10,000 in bonds. What the Federal Reserve does in this situation is that if no one, well, essentially, if no one wants to buy those bonds, the Federal Reserve would in turn buy those bonds, and then basically they're giving money to the U.S. Treasury so that the U.S. government can be funded. Now, there's a lot of controversy in that because essentially it's a loop. The U.S. Treasury issues bonds, the Federal Reserve buys those bonds, and everybody's hunky dory. So basically, the U.S. Treasury can get away with not with carrying budget deficits. Basically, if they can't make enough money collecting taxes, then what they can do is they can go on the open market, sell bonds, which the Federal Reserve will buy and put it on its balance sheet. So when that happens, the money supply increases, giving now the U.S. government more money to spend. They're basically saying now that they are going to reduce the balance sheet, and which basically means when you reduce the balance sheet, they're going to now take those bonds, or let me clarify. What they're going to do before they're going to sell any bonds, that's not what their intent is. They're not selling any treasuries that they bought from the US Treasury. What they want to do is they want to taper down. So they want to stop buying US Treasuries. And essentially stop aiding in the money supply or aiding in the federal government carrying over deficits. So what that does is that reduces the amount of money in the money supply, which makes sense, but it also affects inflation and deflation. So what inflation is, the definition of inflation is when a government increases the money supply by printing money, and that's what causes money to inflate. So actually, inflation is when money inflates. So when money grows. So when money grows, all assets inflate because of this. But it's only because of the action of a government producing more money, more dollar bills. And what now the concern of the Federal Reserve is that inflation is here. And it seems that they cannot control it. Well, that's my opinion. I don't know if they can control it or not. Truth be told, we won't know. The U.S. government right now is carrying a $29 trillion, not deficit, but debt. That's the debt of the U.S. government. So that's what the U.S. government owes essentially to anyone who holds debt, or who holds U.S. debt, excuse me. And how does the rates, earlier I was discussing the Fed rate and how raising it how would it affect us? So how would it affect the consumer is that essentially if you raise interest rates, you are now preventing money from being lent out. And when that happens, you have less money to spend. When you have less money to spend, the demand of assets goes down. And when the demand of assets goes down, you're causing a deflationary move, which basically lowers the cost of goods to be sold. So the prices of things, aka commodities, milk, coffee, sugar, gold, silver, oil, all that should go down. Now, I did mention gold and silver. That's a little bit more complicated considering those are hedges against inflation. But remember, if it's a deflationary situation, that means all assets go down compared to the dollar. So basically what happens is you make the dollar stronger, which causes all assets to go down in value. I know these are abstract thoughts and ideas, but In reality, the Federal Reserve is part of what controls the prices of goods going up or down. It also controls how money is going to be lent out from a bank to a consumer to an investor. So the stock market today went down. The Dow Jones, the S&P 500, and the Nasdaq, the Russell, I think it was Russell 2000. These are all indexes where publicly traded companies trade on. They all dipped, and the reason they went down was because if the price of if inflation, excuse me, let me clarify. If interest rates were to rise, then what happens is it becomes harder for businesses to borrow money. And if it becomes harder for a business to borrow money, it essentially becomes harder to do business. And when it becomes harder to do business, the valuation of your business has to go down. So that's what happens. Now, obviously, this is only one factor that caused caused valuations to drop. There are other factors here at play. But here we are talking about the Federal Reserve. I don't want to jump into any other subject that might conflict with this idea. So the notion now is that if the Federal Reserve raises rates, the concern is a recession will occur. I think, full disclosure, I'm not a financial planner, so here goes my opinion on the matter. The Federal Reserve raising rates, even to 1%, would cause a recession, not because the economy can't take it. It's more about the psychology of the economy, or the psychology of investors. When you raise rates, automatically investors get spooked, and they come to the conclusion that if it becomes harder for businesses to borrow money, then it's going to be harder for businesses to do business, which I was saying earlier. Is that necessarily true? I don't think so, because what happens is that there are good businesses, there are bad businesses, there are businesses that their industry relies on debt, and then there's businesses that have no debt. So if you're an investor and they raise rates, you're going to go to safety, which safety means basically you want to invest in companies that have good growth, good sales, great cash flow, and who don't need to consume debt to survive. So I'll say this: what businesses do rely on debt are technology companies. Even though technology companies have tons of cash on their balance sheet, they do rely on debt to survive. Even the biggest tech companies have a lot of debt on their balance sheet to survive. A good example of what I think is important to understand would be a company like Tesla. Now, most people do not buy. Let's look at it like this. Let's break down Tesla for a second. So Tesla is a technology company. When you invest in Tesla, you're investing in the future. You're not investing today. You're not looking at Tesla as this car company that outpaces Toyota or General Motors or Ford or Mercedes-Benz, because they don't. They produced last 3 months, 300,000 cars. That's nothing. Toyota, I think, produces 10 million cars a year. So you can imagine, and when I say produce, I mean they sell 10 million cars a year. So when you hear that, you have to ask yourself, how can Tesla be worth more in terms of valuation than a company like Toyota? Well, the reason why it's worth more is because you as an investor are investing in the future of Tesla. You're not investing in the now, in the 300,000 cars every 3 months they sell. No, you're investing in the idea that 5 years from now, 10 years from now, they're going to be the number one electric vehicle automaker, or the best, or the number one, right? So when you take that into account, you are willing to invest, to sacrifice basically today's growth for tomorrow. So with that said, the market now has to take into account that if rates go up, now the valuations change. Because like I said to you before, if interest rates go up, it's harder to borrow money. It's harder to borrow money. It's harder to invest that money. Now, 1% is nothing. But there's another factor here that has nothing to do with the stock market or Tesla or anything connected to that. The most important thing is understanding how debt works. So the US government has almost $30 trillion in debt. Now they actually have more. They have actually $150 trillion in debt. But those liabilities are connected to the Social Security Fund or Medicare, or Medicaid. They borrowed against the U.S. government in the last since 1971, since the gold standard has dropped, has basically borrowed against the future of the United States. Now the question ultimately will become to the future of the to the economy of the United States, or even the world's future when it comes to the US dollar, is that how much can it sustain? And so right now it sustains almost 29.5 trillion, and we're not in a recession, we're not in a depression. Um, all commodities in the world are still based in the US dollar. The US dollar is still number one. Um, and so so basically when you look at it, you have to say to yourself, what will it take to break the United States? No one knows. No one knows that answer. It's all hypothetical. It's really a question of um, will there be another country that supersedes the United States? And there's a few candidates up there. Everybody's looking to China. China is interesting in the fact that China still depends on foreign entities, or excuse me, foreign nations to survive. They do supply 60 to 70% of the world's goods because they produce it. They don't actually own the means because it's mostly foreign businesses that control those means. But what's interesting about that is if they can flip their economy to where their citizens buy the majority of the goods they make, well, then they're the new America. And then the question will ultimately become, will other nations want to use their currency? As of right now, the answer is no. I don't know what the future holds. But as an investor, I'm always hedging. So the way I invest, and full disclosure, I am not a financial planner. Everything I'm about to say is just for me and me only. You do not have to take my advice. But I think it's important to understand that some of the when you invest, when you invest in anything, it's nice to take an opposite side or to hedge. So a hedge is basically when you invest in something that doesn't correlate. It doesn't go along with that investment. I'll give an example. If you invest, this is very tricky. So I'll say this. I invested in an instrument called the SQQQ, which basically shorts the NASDAQ. QQQ stands for the NASDAQ. It's an ETF that follows the NASDAQ. S is standing for short. So I'm shorting the QQQ. I'm shorting the NASDAQ. So my hedge is against the NASDAQ. Now, mind you, I have investments in the NASDAQ. So I'm not betting against myself, essentially, but I am making a small bet against the NASDAQ going up. So if the NASDAQ was to correct, correction is 10% or more down from the 52-week high. That means I'm able to not lose as much money as I would if I didn't bet against it. So it's just a hedge. I'll give another example. Gold and silver are a hedge against the US dollar. So if the US dollar was to collapse, which I don't think it's going to collapse anytime soon, but if the worth of the dollar does go down, gold and silver will hold its value against the dollar. So, and let's say it doesn't. Let's say it doesn't go down. Let's say it never goes down. Let's say it stays strong forever and ever. Then your gold and silver would stay where it is now. It would stay. It would be stable. And if you ever needed it, you just sell it. You can own the physical. You can own a mine. Obviously, owning physical gold and silver is probably a very conservative investment, to say the least. And I think every portfolio should have gold and silver. Unfortunately, they don't really talk about it so much and the mainstream media. Now, I'm not trying to be political here. I'm just trying to make a point that people have a tendency to follow what others do. That's just the human side of anything. So on an investment aspect, we see Bitcoin being pushed or cryptocurrency being pushed, and then you see many uh, young investors under the 20 something year old who's like, oh, my friend made money, I'll buy it. Well, it's a little bit more complicated than that because, well, it's actually simple. Cryptocurrency, aka Bitcoin, Ethereum, anything, altcoins, NFTs, all these are correlated to only actually one thing: supply and demand. There's no intrinsic value to Bitcoin. Now there's a lot of Bitcoin enthusiasts that make the same argument about anything, about the chair I'm sitting on. Now, if I paid $1,000 for this chair and the value goes to zero because no one wants to buy it, I could still use this chair. Bitcoin you can't actually use. I mean, you can use it, but most people in the world, which is almost 8 billion people, do not accept it as a form of currency. This is the most important thing. And this is where I stand firmly on why I would not invest in a crypto. Now, if you want to, that's fine. But remember, the money you invest in crypto is the money you're willing to lose. It's a gamble. So if you go to a casino and you come with $1,000, just know you're willing to lose that $1,000. That's crypto. That's investing in crypto. But back to what I was going to say, when it comes to, for me to understand why would I invest in crypto, the only reason why somebody would invest in crypto, other than it being a risky asset, is if in the future someone will buy or sell buy your home for Bitcoin. Now, if homes, one of the most essential things to humanity's survival is your dwelling, is where you live. If you own it, great. If you don't, you're just making someone else rich. But if you don't, I will not accept Bitcoin for my home. I would not. Would I accept gold? Hell yeah. Gold, I'll accept any day of the week. Somebody tells me they want my home. I'll give an example. If somebody says they want to buy my house for $50,000 and it's worth $50,000 and I'm willing to sell, I'll take $50,000 in gold. I will not take $50,000 in Bitcoin. Bitcoin is extremely volatile. So by the time I get to Bitcoin, maybe I lost 10%, maybe I made 10% more on my sale, on the sale of my home. But gold is very strong. It doesn't move as much. It moves slow, which it should, because it's a safe haven asset. I think it's unfortunate they don't dwell too much time on safety. You don't hear people really saying, "Oh, I should invest in a company like Coca-Cola or Campbell Soup." These are boring. These are boring companies. Now, if you watch CNBC and Bloomberg all day, they're going to mention these companies. Obviously, they're going to mention all assets, all financial assets, but then they push crypto. They push NFTs. They're obviously trying to, mind you, it's a news cycle. So they're trying to gain as much of the viewership as they can. I think they're doing a disservice to a lot of younger people who haven't seen financial calamity in their life, whose parents might have suffered during 08 and 09, but they don't. It's different when you are a young person, a teenager, a kid, than when you're an adult and you're making your own money to see someone suffer on that financial level. It's a different emotional reaction. It's a different feeling. And I think in order to respect the markets, you're going to have to suffer a little bit. You're going to have to burn. And so I hope that I'm wrong about crypto. I really do hope I'm wrong. I don't want to see anyone suffer, especially financially, because you work so hard for your money. Even if you got those PPP loans and you got the stimulus checks, it's still money. You don't want it to just go to waste. So I know that I diverted here from the Federal Reserve, but I think it's important to understand how rates work, what that would do as an investor, which I discussed. But there's one last thing I would like to talk about, and that is how interest rates affect bonds. So bonds are boring. Bonds are a horrible investment, horrible, but they do tell a lot about the future of the economy. So if I'll give an example, when U.S. Treasuries, specifically the 10-year and the 30-year, if the third this is the 30-year, your 10-year, they usually go like this. So 30-year U.S. Treasury is usually worth, um, in terms of rate, in terms of the interest, it's higher in interest rate. 10 years higher. But sometimes they cross. They call it the death cross. And when they cross, that usually is a signal that something in the market is about to happen. I don't have the statistics here because I wasn't prepared to talk about this. But when they do cross, it does signal to the market that something bad is about to happen. And usually bad meaning the market crashes or corrects or there's a recession or a depression that comes. And this is a leading indicator of things to come. But another leading indicator about rates, besides them, the 30-year and the 10-year crossing, is when bond yields on the 10-year, specifically the 10-year, start to rise, and they rise without any intervention from the Federal Reserve, that means people are selling their bonds. Someone is selling bonds. And when someone's selling bonds and going into cash, they're they're basically telling the markets, run into safety. Sell your bonds, sell your stock, get ready for something bad to happen. And today in the last few days, we actually did see the 10-year treasury note go from 1.5% interest to 1.7. And after that happened, actually the stock market did dip. So the market was telling us that something in terms of the Federal Reserve, something was going to happen. And it did. The minutes show, excuse me, the minutes do show how the Federal Reserve is going to start to taper and raise rates. Will they do it? I don't know. I think it's scary to know that there are people who I think that most of the world is starting to lose faith in the U.S. Federal Reserve because they weren't so honest. In the last 50 years, they've been basically disclosing publicly their full transparent actions. And I would say since 0809, they've been doing some dubious things that haven't been helping consumers, that they've only been helping investors. And investors are only one part of our economy. The most important thing of the US or any economy is the consumer. Investors are secondary, and that's how it should be. Unfortunately, since 0809, since that financial calamity, investors have been first. And because of that, interest rates haven't been, they did not rise. They didn't think about the actions of the federal government, the monetary policy of the federal government, and how it would affect consumers. They were more concerned about investors. And because of that, they have been printing a lot of money. And we will, as consumers, suffer because of it. We are suffering now. Inflation is going up. Prices are going up. Now you hear people saying they all the time keep pushing the idea that right now the pandemic is the cause of all this inflation. It is not the cause of all of this inflation. The virus doesn't have any effect. It's us as human beings who decided to make choices that affected us. And you can blame the pandemic, but we had pandemics before. We did. We had something far worse than SARS and the swine flu. We had the Spanish flu. The Spanish flu, governments in the world did nothing. They didn't do anything. They just let it be. And the Spanish flu started in about 1918, towards the end of World War I. And it ended in about 1922, 1923. And then in the 1920s, we had great prosperity. Now, that's for another discussion. But for now, just to know, I think the informed investor and consumer has to just take into account what inflation will do to us. So even if we raise rates to 1% and there is a recession and the markets do take a dive, the Federal Reserve does not care for the consumer. Remember that. So they're going to do everything to prop up markets again. And when they do, that will affect all of us. So I think I'm going to leave you with this. This is very important. Diversify and become educated. Educate yourself on all things money. Very important. They don't teach this in school. They don't in business school. They touch on it, but they don't really go into it because it's very hard and it's abstract, especially if you can't relate to what they're saying. Now, I'm not saying it's hard to understand the concept. I'm just saying they just don't dive into the right or it's in the proper avenues of the economy, of money. With that said, I appreciate you watching this video. Please subscribe. Please hit that like button, and I will continue pushing education out there and trying to help everybody understand what money really is and how to make more of it. Thank you. Have a great night.